Welcome to the daily update. This is Being Prepared Friday, October 21st, where we'll look at the action in the market today and then see how things look for Monday, October 24th. We had a nice solid up day. Now, please keep in mind that it was options expiration. And sometimes when we have a good solid move up on options Friday, really they options expire on Saturday, but the last trading day is on Friday. Sometimes when Friday is strong, that can bring in some weakness on Monday because you have a lot of shares and option contracts that are being exercised. They're shifting hands, especially if somebody's already seeing a profit. They may decide to go ahead and sell that on Monday. Not always, but we just want to bear in mind that sometimes the Monday after options expiration can be weak. Let's go back and talk about what happened. Right at the open, we had a higher open, not necessarily a really big gap, but we ended up shooting up right away above the daily pivot at 36.86, and we went all the way up to R1 at 37.16. Then, as usual, prices fell back and went even below the daily pivot, but never did go negative. We didn't even get down to the unchanged level. So that kept things more positive, even though we saw some weakness coming into the market. As the day went on, buyers came back in. We went back to R1 and we even went above that, but we didn't get up to R2 at 37.66. And we ended up closing really near the high for the day. So that it was a pretty positive session overall, and it's helped a lot of our charts to really show some improvement. We were up 2.37% on above average volume. Now, a lot of that is because it was the third Friday of the month. That's options expiration. And so we generally see a real pickup in volume on that day. Our technicals, they're trying to switch back more to positive. We're still negative overall, but we're trying to see, can some kind of support and follow through continue to the upside? Of course, the real fixation are inflation and interest rates. That's the same, and it'll probably be the same way for the foreseeable future. We still have a lot of geopolitical concerns. Russia, Ukraine, they're having some problems again in the UK. It's kind of interesting. Just 6 weeks ago, they had a new prime minister after they basically told Boris Johnson to leave, and now there's a chance he might be coming back. So things are kind of crazy there right now. And then there is some Fed speak that we have to deal with, and I'll go through that here in just a moment. So some comments. Again, it was options expiration, rising interest rates. They were down on Friday, so that gave a lot of support to stocks. If interest rates start to go back up, that's going to put more pressure on stocks and have things drop. Then there was some article that came out in the Wall Street Journal written by a guy named Nick I have no idea how to say his name, Timiraos. And usually articles that appear even in something like the Wall Street Journal, kind of take it for what it's worth. But this seemed to help a little bit more than usual with this dovish scenario. This will be the fifth or sixth time this year that the markets have tried to use this scenario to justify prices going higher. And it's because this reporter is considered to be the Fed's preferred source for leaking insights or to what they're thinking in the Fed. There's a reputation that this person has been used before. And in this article, he indicated that the Fed will probably raise rates by another 75 basis points or 0.75% at the November meeting, which is coming up here pretty soon. But then will possibly consider a smaller increase at the December meeting. That has kind of sparked this whole, maybe the Fed is starting to turn more dovish. They're trying to do that in the UK. They're trying to do that in Australia. They're trying to do that in other central banks around the world. Is the Fed going to start to move to a more dovish stance, which would give more support for stocks to go higher? Also, the Fed president of the San Francisco branch, who's not an FOMC voter, said that she thinks stepping down on the pace of rate increases will help preserve market structure. Okay, that's just a fancy way of saying if we stopped raising interest rates, maybe the market will go up. Then there was the St. Louis Fed president, Bullard. We've heard of this gentleman before. He is an FOMC voter, said that he hopes to get a deflationary process going in 2023. That's what the Fed's trying to do, bring down interest rates. When inflation starts to go down, that's deflationary. And he also added, which is something that we've already known, that the job market remains pretty strong. And that's kind of getting in the way of this happening. Yeah, we're really suffering economically, but the unemployment rate is still very low. There's still lots of jobs available for folks. So until that gets more in line, they're going to have a hard time justifying lowering interest rates. And then these comments were supported in the markets that helped not only stocks, but bonds also go up. In Friday's session, the Dow came right up to its 50-period simple moving average, and I'll show the chart later of that. We still have the 10 to the 5, the 10 to the 2, the 30 to the 5. Those yield curves are still inverted currently, but the 10 to the 3-month is not inverted. It only was that way for one day. Sentiment has switched back more to neutral now. And we didn't really have any reports that came out. There was the Treasury balance or some deficit report that came out later in the day that really doesn't have that big of an influence on the market. So we really didn't have any economic reports to drive prices one way or the other. Our trend is still negative, but it's weakening. It's falling below the moving average. So it's starting to go down, but we're still above 20. And because of the solid up day, I went ahead and switched the bias to positive. Usually the bias is if we had an up day, it's positive, a down day, it's negative. Sometimes I fiddle with that a little bit. The momentum I'm still keeping is mixed because there's potentially the possibility that Monday might see some weakness. Maybe this was more of an anomaly on Friday because of options expiration. We need to see more follow through. We've seen a lot of down days. And if you look at a chart that I'll show in just a moment, we really haven't gone anywhere. We just kind of chopped back to where we were before. All right, here's the update of our World Series indicator, our tongue in cheek. Right now, in the NLCS, Philadelphia leads San Diego 2-1. This is not the World Series. If Philadelphia wins, whoever wins this, will go to the World Series, but anytime Philadelphia has won in 1929, 1930, 1980, 2008, those were very bad economic years. And as I've been saying all along, this is a coincidence. You cannot connect the two to each other. Let's go back and talk about today's sentiment. Here's sentiment. We're getting back up into the neutral range now. We're not showing much fear. We're not showing a lot of greed. We're getting more towards the middle. And over on the right-hand side, you can see how sentiment has been improving as of late. Even on the down day on Thursday, sentiment still improved slightly. Here is the latest reading from individual investors. They still remain extreme pessimistic. So this, when we show really extreme readings like this, that is often used as a contrary indicator, which could give some support to prices going up. Also, when you look at the 10-year real U.S. Treasury yield, that's taking into account inflation, and it's inverted. That's the light blue line. So really, even though it's going down here, it really means that it's going up because they flipped it upside down. And then the forward PE ratio, that's looking ahead in earnings as to what do they think the PE ratio will be into the future for the S&P 500. As interest rates have been going up, essentially, the S&P and the PE ratio has been coming down. So if you invert these, they're having a tendency to go in opposite directions. And it's what I've been talking about in the videos. Interest rates are really pressuring stocks, and they're also pressuring the forward look for earnings of stocks, and that's also pushing prices down. Here's another one looking at the tech sector relative to the S&P. This is a weekly chart. This is causing a little bit of concern. This is what we call a head and shoulders topping pattern. There's a typo right here. Technology stalled at the March 2000 high. Well, it did stall at the 2000 high, but I think they meant either the 2021 high. I think there was a typo in this. But here you have the left shoulder, the head, and then the right shoulder. This is usually a bearish pattern, which means that technology could still fall. Now, this tends to be a very reliable chart pattern, but it doesn't always mean that it will play out that way. There's a lot of subjectivity here. Is this really a shoulder? Is this really a shoulder? You can kind of see the head, it's sticking out there, but that's why I don't use a lot of charting patterns like this, because they are so subjective. You could take 10 people and they could all see something slightly different. And I like things that are a little more cut and dry personally, but just be aware of that. Technology has had a really difficult 2022, and there may be some more pain to come. Here is the debt allocation. It's down. It actually dropped down to 17%. This is how many people are in bonds. That's what debt is. You're loaning money out to an entity. Well, it's come up off of that. Could this be an extreme negative reading? Because it's gone from 17 back up to 20%. So it's seeing a bit of a rebound coming into the various bond markets. Here, we show this every month when we get this. This is the truck tonnage index. And that's the purple line. I'm sorry, the S&P is the purple line. We'll see how it's been coming down, but truck sales are still pretty solid right now. And over the course of time, these lines tend to move in the same direction and not get very far apart. Over the last few months, they've been inching their way back closer to each other. What's going to continue happening? Is the orange line going to keep going up, or is the purple line going to keep coming down? That's what we're kind of waiting to see what will play out right now. Here's just a historical look at the Federal Reserve and the financial crisis, just going back to 1976. You might want to pause this and just look this over. This is when different things have happened. I'm not going to take a lot of time to go through this. I could spend 3 hours just on this chart all by itself. But way over here on the right, this is where we're at right now with a bunch of question marks as the Fed has been raising interest rates. Then we have, it says 91% say that the global earnings per share is unlikely to rise 10% or more over the next year. So the dark blue line, that's the forward-looking earnings per share for the S&P 500, and that's been on a decline. And then these are the percent of folks saying that corporate earnings will improve. That's also been declining. And that's why we're seeing the market really have some trouble. You have to have earnings as the basis for stock prices to go higher. If you don't have those earnings, stock prices will go lower. Here's another one. This is privately owned housing units. When this tends to spike up and then start to go down, that usually happens not long before we enter into a recession. Well, we spiked up here, and there's been some real weakness in housing lately, and so this is starting to come down. That might suggest that if we're not already in a recession, that we might head into a recession. They keep raising the terminal rate. This is when the Fed is going to top out with their interest rate increases. Right now, according to this, it's at 4.99%, which is just about 5%. And remember when it was at 4, then it was at 3. I mean, they've just been increasing this all along. Then we're also looking at copper. We call it Dr. Copper because when Dr. Copper is going up, that generally means better economic times ahead. When it's falling, as it was doing here earlier in 2022, that means the economy will get weaker. Now they're trying to point this out that we're actually declining. For the last number of months, we've pretty much been going sideways. And I addressed this chart and some ratios in the weekly update video that I post as well. So even though they're trying to make more of a negative slant on this, I'm seeing that this is really more sideways overall, unless we drop below this purple line. And we haven't done that yet. Then this is the leading economic index or leading economic indicator. This is what came out this past week, and that is the light blue line here, and it shows that looking into the future, this indicator is suggesting that the economy is going to get weaker. The next chart, this is our market implied US recession probability has shifted above 40%. Okay, so that's this chart way over on the right-hand side. And I'm trying to see, I think this open diamond here was the COVID high. This is the market implied probability of being in a recession and the market implied probability of a recession starting in 1 year. Okay, so I was incorrect. This diamond is, do people think we're in a recession right now? Not quite as much as those that think that we will be in a recession a year from now. Another chart, worsening risks to financial stability now weighing on equities. So we're looking, when this chart is near the top, that means that equities are less risky. When they get down to this level, that means that they're more risky, but oftentimes this can signal some kind of a bottom in the market as well. Then sector flows. You still have a lot of people in this yellow area. They're sucking money into technology, even though it's really suffered in 2022. Look at this bottom line. The purple one, that's financials. And people have been taking money out of financials. And that's one of the sectors that's been showing some improvement lately. So you can see that trying to time the market based on, well, it's going to come back, is not always the right thing to do. Or buy the dips. Okay, sometimes the dips turn into an actual decline. Then looking at the BPI, which I'll show you another version of this chart later on the S&P, where we hit an extreme negative reading not very long ago. Well, it's been showing some improvement as of late. When this chart came out, it was at 22.6. We've actually climbed above that because this chart's now a few days old. And let me try to get to the right chart here. Okay, then this is what is on the minds of investors. What remains the key factor for the Fed, but watch out for the next credit event. Well, right now, we're watching the Fed, and they always say, don't fight the Fed. When the Fed is raising interest rates, don't try to go against that. As many times as the market has tried to do that in 2022, but what's going to cause them to start lowering interest rates or at least stop raising them? That's if the PCE deflator that comes out with the PCE, that's a different report than the CPI. When that drops below 4%, well, back in September, that's what a lot of people were thinking. Not so many in October, but it's still number one on the list. Is there going to be some kind of global credit event? That's what more people are starting to think now. We're seeing problems in the UK. There's been problems developing in Japan. There's problems in the EU. Is that going to lead to some kind of global issue that's going to force the Fed to stop raising interest rates, if not lower them? When the initial unemployment claims rise above 300,000, well, we've been in the low 200,000s for quite a while now, but there's still people watching that to see if the employment situation is starting to weaken. If the Dow drops below 3,000, more people are thinking that right now. And then the high yield bond spreads rise back above 600 basis points. That's the spread between risky and not as risky bonds. There were a lot more people thinking that in September than were thinking that in October. So what the markets are really watching right now is the PCE reports and the deflator or the inflation rate that it comes out with. Then we had another update of the Atlanta GDP Now model, where this is what they're estimating, just under 3% for the third quarter. Well, when you take the top 10 people that are more optimistic about things, they're saying we're going to be just a little bit over 1% right now. The bottom 10, the real pessimists out there, they actually think that we're going to have a slightly negative GDP for the third quarter. Then these are existing home sales on a year-over-year basis. This just goes with what we've been seeing lately is weakening in the housing market. Then we have the latest reading of the Ridex bear bull ratio, and these folks have just been getting whipsawed like crazy. Remember, this is a couple days old. This was after the decline that we saw on Thursday, so they got back into their bearish funds. When this goes up, people are getting into the bearish funds. When this starts coming down, they're getting into the bullish funds. Think of this like you would the VIX. Well, they tend to follow what already happened in the market. So they probably saw some pretty significant losses on Friday with that solid up day. And then what'll happen is in the next reading, this will come down. And even if we have a down day, they're doing exactly the wrong thing at exactly the wrong time. All right, then we had the latest reading of the active asset managers, where after giving us a really extreme negative reading, they're starting to show some improvement. We're getting back up, not quite to the neutral area right now. Usually it's about 60 or so when we're neutral, but this is starting to show some improvement that these folks, when this was taken, they're starting to buy more stocks. Then in Friday's session, we had just pretty much across the board strength, especially in the large caps. Growth outperformed value, where in the mid caps, they were both up, but growth underperformed. And even in small caps, it underperformed slightly. So it was more of a broad-based advance. With the advance that we saw, the VIX really did decline, both on a closing basis, and we can see that the bars, we're seeing a succession of lower highs and lower lows with the VIX. So fear is starting to come out of the market. The VIX of the VIX, as the VIX declines, the VIX of the VIX is also declining. That just means that there's less volatility in the market. This is the daily chart of the Ulcer Index, which is taking us back down a little bit above the moving average. Here's the weekly chart. This is, again, I'm kind of sticking with this weekly chart to show that there's still a lot of fear, even though we're drifting up more towards the neutral area. If we see more of an advance, then I'll go back to what the daily chart's saying. But right now, I would still go with fear is pretty high currently. We're down 22.12% from the all-time high. And the equity put call ratio, it really declined on the daily chart with the up day. And then we set this spike with the 5-period equity put call ratio, and it has been declining as well. And I'll have a longer chart to show you at the end. Here are the support levels for Monday's session, and they're posted on the YouTube channel under the community tab. And here's a daily chart showing how we came right up to the pivot, and that is acting as resistance. And we closed just a little bit under that. It would be a lot more positive if we can continue to go up from here. And you can kind of see where we bounced up, we came down for a few days, now we bounced back up. So we're kind of on a treadmill right now. Here is the Fibonacci levels where we're still underneath these overlapping fib retracement levels right now. And we're just at the top end of the very short-term range that we've been dealing with. We're back above the 100% retracement level when you go back to the low set in 2021. So we were able to regain that, but we regained it before only to lose it, only to get it back. So we're chopping around a bit right now. Here's the important one that I've been watching. This is a weekly chart, and we're pretty far above the 200-week moving average now. If we continue to go higher, we want to see, can we get above this 38.2% retracement, which is at about 38.19 or so. Yeah, we're getting up about into the midpoint of our trend channel. So after falling a little bit below it, we're starting to show some improvement currently. As far as the sectors on Friday, every one of them was up, led by materials, financials, and discretionary, which has just been getting hammered in 2022. The real estate sector, it was up slightly, and communication. These are two real weak sectors in 2022. The chart that's looking the best is the energy sector at 99.6. And we still have real estate looking the worst at 4.6. And here it just shows we're up over 50% now in the energy sector since the all-time high. Now, it hasn't been clear sailing all the way to 50%, but we lost some of that, and now it's starting to regain some of that back. Healthcare is now in second place, and third place is utilities, which had been in second place. And you have discretionary and communication, which are taking up the last place spots. Here is an update of how the different indexes have performed since the S&P set its all-time high way back in January. That's the pink box right here. Our technical alerts, some positive, some negative. At first, the NASDAQ went below 10.6. Then it got back above 10.6, over 10.7, 10.8. So the NASDAQ had a pretty good day. The S&P was able to get above 3,700. We had an energy BPI cross above 70. That's positive, but starting to get a little extreme positive. And then we had the materials BPI cross above 30. After being extreme negative, it's starting to come back more positive. And gold set a 2-year low that, it should have been to the moon by now. Well, it's still having problems. Even though it was up on the day, it did set a 2-year low. No matter, you've got a lot of gold folks out there that are just totally convinced that this is it. This is it. Well, this is it. Just keeps happening over a long period of time. And then oil was able to get back above 85. We have the Dow, which has the best looking chart right now. It's looking more respectable at 84.6. When these get really strong is when these scores get into the 90s. Then in second place are the small caps, and they're in a distant second. They're at 64.4. The mid caps also at 61.6. In fourth place is the S&P at 53.8. So it still has a lot of work to do. And then the Qs are in last place at 26.5. Here's intraday what happened, where we had kind of a flat to higher open. We were able to get above the pivot. We got all the way up to R1. We retraced down below the pivot, never went negative, and then saw some buying coming in, took us back above the pivot. We eventually got above R1, never made it up to R2, and then ended up closing just about at the high. So it was a pretty positive day. Our trend, because the red line is on top and it's declining, that means the ADX is starting to show some weakness. It's still above 20, but it's below the moving average. Our Arun is starting to show some improvement. When you take the selling pressure that's been declining and the buying power that's been increasing, our oscillator is starting to turn back up after giving us an extreme negative reading. Looking at breadth, we saw some improvement, another powerful update based on price, but it's going to take a lot to get back up to this moving average, both based on price and volume. And then our advanced decline ratio, still slightly negative here. We're below this midpoint, but it is showing some improvement. New highs, new lows, we're not really breaking out one way or the other because we're in this sideways pattern that we've been in recently. So until we break out one either up or down, we're not going to see a real expansion either way right now. So the 5-period new highs, new lows are still showing some improvement, and we're a little bit better with the 10-day moving average. Accumulation distribution showing some improvement, but still below a declining moving average. Short term, we might have overdone it on Friday with that 2 3/4% gain. We were a little extreme with the advanced decline ratio. Hey, look at this. I haven't seen any moving averages in a while. Now, these are the short-term moving averages. We were able to regain the 10 and the 20. Now we're going to see, can we get back up to the 30, the 40? The 50 is going to be a big one. But we are seeing a little bit of improvement, but this is still an overall downtrend. And we finally were able to break above the 20-period, both simple and exponential moving average. Can we stay above that? Looking back 5 periods, we're looking a little extreme with the rate of change. And I should have flip-flopped these. Going back on just a 1-day basis, we might have overdone it in Friday's session. The Stochk RSI is looking a little extreme positive, and the Williams percent R starting to get into extreme positive territory. The Force Index is showing a lot of improvement and is not necessarily extreme. It is not hitting the upper band of the Keltner band right here. The Swinland Trading Oscillator, based on price and volume, is showing some improvement. They're both above 0 and advancing. Our McClellan Oscillator, after almost giving us an extreme positive reading, came back down, and it's looking more positive currently. Our moving averages, the 20, 50, and 200, are showing signs of some improvement. Maybe not as much with the 200. It takes a little longer for that to turn up. The short-term stochastics starting to get extreme positive, still looking okay with the intermediate term and getting more positive with the longer term. Intermediate term charts, still not working our way out of an extreme negative reading with the 50-period rate of change. The Sean trend meter is showing some improvement and looking more positive. Our PMO is positive, and we crossed based on price and volume recently, looking a little extreme with our PMO study with those PMOs that are rising, but we're seeing some improvement with the buy signals, and those PMOs that are above zero is also showing an improvement. Chaikin oscillator also showing improvement. Chaikin money flow, even though these bars are still red, they're getting lower and lower, closer to zero. So that is showing some improvement. We saw a little bit of an upturn in volume because of options expiration. The vortex continues to be positive with the green line on top and the red line on bottom. Our summation index based on price is turned up after giving us an extreme negative reading, and it turned up even before that based on volume. So this is looking more positive. All of our oscillators now are pointed up. The slope, the MACD, the KST, the TRIX, the PMO, the TSI, they're all giving us an upward signal. The BPI, after crossing above 30, it did increase a little bit. It's having a hard time really moving fast because it's seeing this whole mess of things, of prices where we've been at recently. The ease of movement, it actually turned down a little bit, but is still above the zero line. Ultimate oscillator showing improvement and above 50, so that's positive. Money flow is also above 50 and advancing, that's positive. And our TTM squeeze, probably really hard to see, but there's a little teeny tiny green bar in here now. So that's turning more positive. Balance of power right on the dashed line. If it can cross above that, that would be more positive. If it falls down, that would be more negative. In our CMB composite index, it's showing some improvement after really giving us some kind of crazy signals there, unless you're ultimate short term in your horizon. Our charts with the Heiken Ashi, we have kind of almost a doji looking candle here, but it is showing some improvement. We're still negative with the Kegi where we're red, so that isn't really registered yet. The Renko chart is still negative overall. The 3-line break is showing some improvement with the open candles. Nothing really new on the point and figure chart. No signal, no X's or O's that were added. The elder impulse for the S&P has gone back to green, which is positive after going negative. See, all this chopping around is really confusing this indicator. And we're back to green with the SPY. The SAR, it changed positive earlier in the week, and the dots continue to be underneath, so that is positive. We're back at more of a pale purple reading right now. That's more neutral with a negative slant as far as the go, no-go system. Long term, we're seeing an improvement with the 50, 150, and 200-day moving average study. The rate of change going back 200 periods is trying to come up out of this extreme negative reading that we saw back at the COVID lows. Special K trying to turn up, but it's a long way away from the moving average. But this is a very slow indicator, so it takes a lot for this to turn. Then going back 250 periods, haven't shown this chart in a while. See how we're coming back and matching the COVID lows? That could be an extreme negative reading and might be able to be used as a contrary indicator. Looking at the broad market, we're back to positive with the Dow. And here's where the Dow came right up to its 50-period moving average. Can it break above that? It's been holding up better than some of the other indexes. If we get above the 50-period moving average, can it get above R1? Qs back to positive. And they still have a ways to go to get back to their pivot point, but they're still positive, looking more positive. The Vixen, which is the VIX on the NASDAQ 100, it has also been declining as the Qs have been going up. The NASDAQ still has a ways also to get back to the pivot points. We want to see follow through with the NASDAQ and the NASDAQ 100. That's where the growth is going to come from to help the S&P 500. The mid caps got back just barely above its pivot point, and they've been chopping pretty much sideways as well. And the Wilshire, which is a broad measure, just a little bit underneath the pivot point. Looking at Dow theory, where the Dow seems to be showing some improvement, but we're not seeing that confirmed by the transports right now. And the utilities, which had been doing good, then showed some real weakness. They're bouncing up a little bit, but they're more in line with the transports. So maybe the Dow is getting a little ahead of itself here. The dollar, which was down in Friday's session, almost 0.75%, but is still in an overall uptrend. When we're looking at the correlation between the S&P 500 and the dollar, they're still having a pretty strong tendency to go in opposite directions. Gold, which is supposedly at the moon by now, it was up 1.78%, but it's still in an overall downtrend. Silver was up almost 3.5%. It was able to get back above its 50-day moving average, but is still in an overall downtrend. Oil was up slightly to 85.05, and the correlation between the S&P and oil, they're having a tendency to go in opposite directions now after having been neutral just recently. Looking at bonds, saw a little bit of a bounce with our bond ETF and a little over 0.5% bounce with our world bond index. And looking at our different yields, here's the 10 to the 5-year, which is still inverted. And the 30 to the 5-year, it's starting to show some improvement here, but it's still just ever so slightly inverted. The 10-year to the 2-year remains inverted. The 10-year to the 3-month, which just for one day ticked down and was inverted, has since reclaimed more of a regular yield curve. 10-year treasury yield, after spiking up, is now settled down at 4.213%. And the 30-year, which is actually up at 4.33%. And this just shows how the 2-year yield is still, even though it declined, it's giving you the best return. But some of these other maturities are starting to cross back over each other. And maybe that'll help produce a more healthy yield curve. Our correlation, stocks and bonds, they're having a tendency now to go in opposite directions of each other, according to this. The S&P to the 2-year yield, they're having a tendency to go in the same direction right now. So a lot of this stuff coming out of the UK and the bond market and going up and down and all over the place, it's really kind of wrecking havoc on the markets right now. The S&P to the 10-year also having a tendency to go in the same direction after they had been showing a really strong inverse relationship. The tech sector to the 10-year also, at least over the last day or so, they're going in the same direction. Our scenarios, we'll do an update of these. We're showing some improvement with our 19-day exponential moving average of the advanced decline ratio on the S&P 500. After giving us this real extreme negative reading, it's showing some improvement based on price and volume. And if you look at this, other times we saw this extreme reading, that often marked a bottom in the S&P. Also, the 200-day simple moving average showing a little bit of improvement, but we've been chopping around so much lately that this indicator really hasn't been moving all that much. On a shorter term basis, looking at the 50 period, we're seeing a little bit of improvement with the S&P, with those stocks above their 50 period moving averages. The mid caps also showing some improvement, and the small caps also showing some improvement. The 10-day average of the S&P 500 highs minus the lows showing a little bit of improvement, but this hasn't really changed all that much either. We're kind of congested right now, and we'll need to see a breakout for this to really show some improvement. Looking at the broad market, we're still negative overall when you take the Amex, NASDAQ, and NYSE, and then look at the 5-period moving average of their highs minus the lows. It's still below zero after giving us what could be considered an extreme negative reading, but it's going to have to see some more improvement. The equity put call ratio, this is the same chart that I showed at the beginning. After having this spike up, it has been declining overall. A lot of times that gives support to the S&P 500, but we need to see follow through with price. And if we do have some kind of a decline, we don't want to see the kind of decline that wipes out these scenarios. All right, small caps. We're able to get back above their daily pivot, but they're still below the 50-period moving average. The small cap to S&P 500 ratio actually declined, where we did see a recent spike here, which might give some support to the S&P 500. If the blue chips, the bigger stocks, can start to come back in and take us higher after the S&P 500 was outperforming, that could be positive. Our rotation, still hanging in there okay. It was pretty much flat with the Q to S&P 500 ratio. Saw a little bit of an uptick with discretionary against the S&P, and large cap growth to large cap value coming back up to a declining moving average. And then when you look at large cap growth versus value, mid caps and small caps, we were flat with large caps, a little bit of a decline with the mid caps, and pretty much flat to a slight decline with the small caps. So this isn't really helping us right now. This is helping us. The S&P 500 to the utilities ratio. Again, if you stop and look at this, you notice that when we hit a low in this ratio, that often marked a low in the S&P. Just like when we hit a high and started coming down, that often marked a top in the S&P. This has been slowly but surely improving as the S&P has been doing a little better and utilities have really been suffering. Then the 2-year yield, well, we don't really know. This just keeps going up and up and up and up. So we don't really know if this is a spike right now until we get some time behind us. Then looking at the staples, they were up 1.5%. And so we're still looking at this spike right here. And again, when we have a tendency to spike in the S&P, that often marks a bottom. A spike in this ratio that tends to mark a bottom in the S&P itself. But we've been faked out a lot of times so far in 2022. Copic curve is still giving us a signal, but we're starting to leave this kind of in history right now. So something should happen pretty soon for this to be a valid signal. And we are working off of a signal with the Pring bottom fissure. This still looks okay, but it would be nice if we could see some more follow through with price. So what's our outlook for Monday? The technicals, they're trying to, okay, it's bad English there. Trying to improving. Yes, that's very good. If there is through buying, my goodness, I couldn't have screwed up that sentence anymore if I tried. They're trying to improve if we see more follow through buying. That's what I was trying to say. My goodness. The Monday after a positive options expiration day can often be weak. Doesn't mean it will be, but oftentimes it is. And then we have the preliminary IHS market manufacturing PMI and services PMI reports coming out on Monday. Not a real big deal overall. We've got the whole list of geopolitical events, Russia, Ukraine, inflation and interest rates. That's what the markets are still focused on. Any more Fed speak that we may hear about, the situation in UK, what's going on with all of that. So there's a lot for the markets to be worried about. Our scenarios, we could still go with the down scenario. We haven't switched over positive yet. The technicals are turning positive, but we need to see more buying. We could go with the up scenario, but we can't do that with a lot of conviction yet because we need to see more follow through. And can we break out of this range that we've been in? And we can't really go sideways right now because the ADX is above 20, even though it is declining. So if you're okay with it dropping below the moving average and declining, you might already be in a more neutral stance. Others will want to wait until that actually drops below 20. So what's our conclusion? The S&P is turning positive if buying continues. Yeah. Short term is looking better. Intermediate term looking better. Long term is still negative, and it will be negative until we get above the 200-day moving average. So thank you. Have a wonderful weekend. And I will be preparing the weekly video as well as the intermarket analysis video.